Alright, welcome to another run through of the top 5 charts of the week. This is the free email that goes to subscribers of the website. And it's just a selection of some various charts. So we've got global trade, global equities, US labour market, global equity valuations, and the Euphoriameter. So I'm just going to walk through what they are and the implications. So starting off with the global trade, this is weekly indicators. So two things about weekly indicators. First of all, being higher frequency, it gives you a faster insight into changes in trends, changes in momentum, but also, higher frequency indicators tend to be a little bit more noisier, so as you can see in the chart. But when you integrate, or you use multiple different ones, then it can provide a bit more signal. And certainly what I'm trying to do here with the combined line is to basically provide a combined signal. So anyway, it was decelerating through much of last year, and particularly the first couple of months of this year, and that lines up with some of the other things that we've seen decelerating in terms of like Korean exports, and also softening in the economic surprise indexes. So this rebound here in the last a few weeks is actually quite interesting then, that it didn't actually go all the way down, that it has actually abated a bit. And all three of the indicators, so the Baltic Dry, that's your bulk commodities, the red line is China Containerized Freight Index, that's more broader exports, and the green line is relative performance of shipping stocks. So, but just a quick note on what these are. They're all basically to do with shipping costs or shipping industry, and the logic there is that more demand is going to mean that these things are going to basically head up. So that means more activity, more faster pace of global trade growth is going to push these things higher. So very interesting to see that turnaround there. It'll be telling as to whether that continues to recover or actually rolls over again. So it's a key one to watch, I reckon, because global trade has really been a swing factor for and a key indicator of global growth over the last couple of years. Number two, we've got consumers, manufacturers, and global equities. So likewise, here you can see the global manufacturing PMI did roll over, and that sort of lines up with the softness that we saw in the global trade indicators. And same thing with global equities. And then in the June print here, we've got the consumer sentiment. So this is world GDP weighted. It seems to have had a bit of delayed reaction as well. And it is a little bit of a choppy, volatile index. So you kind of have to wait for the next month's data to see whether that is indeed a accurate representation. Still, even then, the consumer looks relatively stronger than manufacturing. Both of them are at pretty solid levels, so that's, I guess, a big reason why we haven't actually seen global equities push lower as they did in 15-16, when the we did actually see a bit more softness in the PMI and consumer sentiment. So again, this is kind of unique indicators, but pretty key ones to keep track of the global economic pulse. And number three, a little bit different here. So this is the three key measures for the US jobs market. So in the black dark line there, and I've all standardized them using Z-score. In the black line there, that's the unemployment rate. And you always get people saying, well, the unemployment rate's not an accurate view because you've got this and that going on with the participation rate, or you've got to look at the underemployment rate, or people go on about the accuracy of it. But if you look at the consumer confidence index, so in the blue line there, what we've got there is the what we call the ease of finding a new job. So basically, if that indicator, because I've inverted it, the lower that indicator is on this chart, the easier it is for consumers to find jobs. So they're basically saying that jobs are plentiful at the moment. Pretty similar environment in their view to the late 90s. And if you ask a small business, they're having trouble finding skilled employees. That's what we're seeing there. So, the lower that is, the harder it is for small businesses to find, to fill jobs. And they line up completely with the unemployment rate, so don't doubt that signal. The signal from all three is basically saying that the labour market is running hot, and at some point we'll probably see bit of an acceleration in wage growth, if not cost pressures more broadly. So again, this one's really just another way of saying onwards and upwards for the Fed in terms of rate hikes and quantitative tightening. And that's pretty important actually. Very important because, if the Fed continues down that path, we're only going to see further stress coming onto emerging markets and commodities eventually as well, I think. Number 4, global equities. Coming back to global equities, this is just a quick look at where the valuation picture is sitting. And basically there, the correction has driven a slight reset in the valuations. EM fell the most. But the picture is still basically the same. US is still the most expensive. DM much cheaper than US, but EM still at the bottom, about a 25, almost 25% discount versus DMX US, and about a 50% discount, I think it is there. Yep, 50% discount versus USA. But that doesn't mean that they can't go cheaper. And if the Fed presses on with the quantitative tightening and the rate hikes, then I think we possibly could get a bit cheaper on emerging markets. Still, over the long run, these PE10s tend to give a pretty good guide for longer run returns, and as I mentioned in a previous previous report, EM is looking the best, over the longer run on that front. Final one, the Euphoriameter. This is a proprietary sort of unique indicator here. It provides a composite view of investor sentiment. So you can see the components here, forward PE, and you put the forward PE in there as a measure of confidence, because basically the higher that is, the more confidence that investors have in earning power. And obviously to bid the PE ratio up that high to begin with, they're probably pretty fully invested. The bull's line there is an average of the investors' intelligence and AAII surveys, so that's surveyed bullishness, and you can see there that bullishness is pretty much pretty buoyant at the moment. Not as widespread as it been in the past, but pretty much up there. The VIX has actually moved a bit, and that's one of the things that's driving that. The PE ratio, the drop on that's been the key driver of this big move here. Slight reset in bullishness as well, but you can see here that it's moved almost, the indicator itself has moved almost half a standard deviation and actually rebounded. So it's interesting to see it rebound slightly, and if that rebound persists, continues to run through, that's going to be pretty key. I think if you look at situations like 98 there, or perhaps more in common, and 94, 95 there, where it did have the same kind of material reset before markets actually just went up and got back to business. So I think that's pretty key there, that actually, particularly in the backdrop of earnings still pretty solid for America, and macro backdrop still pretty decent actually for America. So that's it for this week. If you want to receive this email each week, it's the top 5 charts of the week, send it out around Tuesdays. If you want to receive that, just I'll put the sign up link in the description of this video. Otherwise, if you've got any comments, questions, put them in the comment section below, and be sure to subscribe to the channel, because I'll be doing more of this sort of thing in the future.